Hello and welcome to Insurance Mantra, your weekly guide to the world of insurance only on ET Now. In today's Leadership Insight, we focus on key question in insurance in India, an affordability problem, not an awareness problem. With rising premiums, can premium financing and EMI can help more people and businesses buy higher cover and reduce protection gap? We'll also look at how fintech and digital lending is changing the way insurance is bought without replacing agent. To discuss all this, I'm joined by Hanut Mehta, CEO of BimaPay. Hanut, welcome to Insurance Mantra.
Hi, thank you for having me.
So Hanut, help us understand what actually is insurance premium financing, and it's allowed under the regulatory framework?
Yeah, so putting it in simple terms, insurance premium financing is where a customer is allowed to pay for its insurance premium in monthly installments via bringing in a lender who finances the entire premium for the particular customer.
Okay.
In terms of regulatory aspects, this is absolutely allowed and has been going on since a few years now. BimaPay came in about 4 years back, and currently we are doing this very aggressively, partnered with some of the largest health insurance companies in India.
Okay. So how big is this overall market of insurance premium financing if we talk about a non-life insurance industry, which is of 3 lakh crore? So in the insurance sector, how big is the insurance premium financing market?
So currently, premium financing is predominantly used in health insurance. So I would trickle down the audience to that, and roughly say around 15,000 crores is what we see as a premium financing market for India today.
Okay, 15,000 crore is the market, and for benefit of our viewers, how interest rates vary in premium financing, because upfront I'll be paying the premium, but it would be charged in form of interest. So what the kind of interest rate end user policy holders end up paying?
So I'll answer that in a very simple example. If your premium is 100 rupees, and if you're taking a 12-month EMI for it, you will be paying a total of 109 rupees to 110 rupees, depending upon how strong is your credit score. So about 9 to 10% per annum is what you pay extra on your current premium if you go for financing.
Okay, and because large section of society still buy insurance through insurance agent, through bank assurance channel. So is this option is available to them also? Because most of policy holders are not aware about the insurance premium financing, and when they want to buy insurance policy, and if it's not affordable, they tend to reduce the sum assured, or they tend to avoid it only.
Correct. So today in the market, if you see, predominantly agents are selling insurance today, and agents act as a key support for premium financing as well, because they are the ones who are well aware about premium financing, and they inform the customer that the customer also has an option to take this kind of financing in order to take a higher sum insured or buy a longer term policy to get their entire family covered for a longer duration. So yes, agents play a very key role in this, and in kind of educating the customers about premium financing.
I was also reading about the surrender value financing for people who need liquidity against the existing life policy without cancelling it. So help us understand what is surrender value financing and how this can help policyholder in urgent need of money.
So surrender value financing is nothing but taking a loan against your existing life insurance policy. So people who have been paying their annual premiums year on year for their life insurance policy have accumulated a sum insured, accumulated a surrender value for themselves, which they can collateralize and take a loan at a very low rate of interest from lenders today. This particularly is called surrender value financing. This could be for any of their personal needs, could be for their children's marriages or education or any other need that they might want the money for. What this does is this helps them to continue their life insurance without surrendering it and still use it as a collateral to borrow easy and a low interest money.
So for surrender value financing also, insurance companies are tying up with insurtech companies, or surrender value financing is done by insurance company only on their own.
So a lot of the insurance companies do this on their own. However, they are restricted to do this on a very small set of product line. The regulator does not allow the insurer himself to finance a lot of policies, for example, market-linked insurances. And majorly there is where the third-party players like the fintechs and the insurtechs come into play. And that is the segment that is largely taken care of by the third parties. However, yes, the core products are also done by the insurers themselves. What the insurtechs kind of do differently here is since we bring in technology along with lending, we help the insurance companies build a end-to-end digital flow for anybody who's looking out to take a surrender value loan, and that simplifies the process for the end customer.
Okay, it simplifies the process for the end customer. But sir, Hanut, for surrender value financing, are there regulatory restrictions? Because regulator is not completely in favor of surrender value financing.
No, in fact, the regulator recently also came out that every insurer should offer their customers an option to borrow against their policies. And in fact, they've promoted
No,
it.
that I
They
agree
also
that
have set out.
insurers should allow, but to tying up with the third party fintech player or insurtech player on the policy, that loan can be taken up.
So insurers do, the regulator does not disallow insurance companies to bring in third-party lenders because it's a very general loan which goes out to the end customer, and the insurance company has no role to play in it. It's a simple assignment process of the policy based on a predefined format which is signed by the policyholder himself. The policyholder through that contract assigns his policy to the lender and basically gets a loan from a third party lender. So we don't see a regulatory challenge here.
And what kind of interest rate varies in surrender value financing? Rate of interest.
Depending upon the surrender value that you've acquired in your policy, but still in the range of say about 9 to 10% per annum would be an interest rate that is charged to the customer.
Okay. And I just want to understand from you about the corporate insurance premium financing also. How big is this market? And our corporates are also going for insurance premium financing, and under the regulation, what are the regulation around this corporate premium financing?
So corporate premium financing is where institutions, smaller institutions, a SME or a MSME, where they have cash flow restrictions, but still have to secure their assets, their employees. They go for a solution like this to manage all of those insurances. The kind of cash flow restrictions any business, a small business would have, they would not want to get away with the insurance coverages of what the coverages that they would need, and that's where premium financing comes in terms of how big is the product. Currently, it's a fairly new product, I would say, as compared to a retail premium financing, but the market is gradually growing and adapting. If you look at the developed countries abroad, premium financing for corporates has been a very large segment. Approximately 40 to 50% of businesses use them. In India, it's fairly new. It's just been about an year maybe since we've also started doing this, and we see a big market being developed for this because the government is also promoting SMEs and MSMEs to a very large extent. New businesses are coming up, small businesses are coming up, and this product basically helps them to not avoid important and key insurances, despite the kind of challenges they face in their cash flows.
Okay. My last question to you, Hanut. this insurance premium financing comes under the category of personal loan only, or there is a separate category defined by RBI like we see in home loan or student loan?
It's a personal loan. Very clearly, it's a personal loan. It comes as a personal loan in the customer CIBIL as well. However, there are certain arrangements and assignments that the customer does with the lenders, and that is still considered under a personal loan arrangement.
So, do you think that what would be your opinion that insurance financing can be categorized under a special category where interest rate can be lower than a personal loan?
Absolutely. Since this market is growing very aggressively and the need for insurance premium financing is also now very certain amongst insurers, the intermediaries, and also now the customers, as and when they're getting aware about this. Once this is properly structured through the regulator and comes up as a recognized product, in terms of a collateral, in terms of a security, this should turn from a personal loan to a secured, structured loan where the interest rates would definitely go down and the benefit would be passed to the end policyholder.
Thank you so much, Hanut, for joining us on Insurance Mantra and sharing your insights. So, time for a short break now. After the break, I'll be joined by Sumanta Ghosh, Chief Technology Officer at Bandhan Life. Stay tuned.